Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profits newsletter service coming to you today from Central Florida, where it's finally starting to warm up out of the low 60s and get back into that mid to upper 70s level starting tomorrow that I consider acceptable winter conditions down here. Now, I mean, when we started back up the videos a couple days ago, I said I would stop talking about sports, and I'm going to go back on my word already. As I'm recording this, the pregame show is on for the most important football game of the year. Speaking, of course, of the Army-Navy game. Now, I grew up in Annapolis, Maryland, decades before 9/11 and the tightened security issues and machine guns at the gate. And when I was a kid, we had pretty much free roam of the academy grounds. We swam in the Middies pool, skated on the ice rink, went to the cantina, played on the practice football fields, broke my arm there once, as a matter of fact, when I was about 12 years old. Uh, and the Naval Academy was just part of the heritage of the town, and you grew up around it. You learn to appreciate the quality and character of the kids that went to school there. Now, I remember going to the Army Navy game. 2006. 2005, somewhere there. Well, it was in Baltimore that year. I don't remember exactly which year. But I got there early and I watched the Brigade of Midshipmen and the Corps of Cadets march onto the field. And I have to tell you, it's an awesome, almost emotional thing to watch. And as I watch these kids walk on, and they're kids, they're 18 to 22 years old, and they're the best and brightest students in the United States for the most part. These kids could have gone to any school, anywhere with a scholarship, because you got to be a pretty smart kid to get into one of the service academies. All of these kids had other opportunities, but all of them in the 4,000 plus Corps and Brigade, 8,000 kids, made the choice to go to the academy and serve their country, even though in today's world, they absolutely know that there's a probability that they will face some sort of combat operation in their 5 year service commitment. Those kids make up the future leaders of the United States military, Congress. They're going to be leaders at all levels, and it's just an awesome thing to watch. And they are the true scholar athletes of big time college football. The athletes on neither side of the field get any soft core courses. They take the economics, political science, engineering, military history, and tactics courses that everybody else in the academy takes. And they have the same outside the classroom responsibilities and duties as well. So this is just a great group of kids who've made an enormous sacrifice and commitment to the United States. And it is just an honor to watch these guys play in this annual classic football game. Now, having said that, I salute both teams, but I'm here to tell you I hope that Navy makes it lucky 13. Go Navy, beat Army. Now, this getting on to the markets. There was the Deal Book Conference in New York City this past week, and one of the speakers was Steven Schwartzman of the Blackstone Group, one of the large private equity firms out there, and he talked about the $4 billion energy-related fund that his firm is just wrapping up. Good timing, I guess, is they're raising all this money as oil just falls wildly out of favor. Crude oil's down 40% so far this year, and we've seen some devastation in the oil and energy-related stocks, and unfortunately, I owned a few of them before all this started, so I got to experience some of the fun and pain firsthand. However, here's what he said looking at the energy field. And this really is close to my own feelings about energy and oil-related stocks going forward. He said that it's a wonderful, wonderful opportunity for us. That's a double wonderful, folks. He said it's going to be one of the best opportunities we have had in many, many years. I completely agree with him. I sent out on my reading list today the ExxonMobil energy outlook from between today and 2040. Energy demand is going up for carbon-based energy. It's not going away. This is really a political thing that the Saudis are doing right now. Motivations have been ascribed to everything from defeating Russia in their oil field to crushing U.S. Oil shale or just protecting market share, particularly in Asia. I don't know why they're doing it. I do know that they can't do it forever. I'm optimistic enough about the world to think that we will eventually get a global economy that gains some traction, picks up steam, creates more oil demand. So We doubled down on some of our financially stronger oil positions in the portfolio. I've got a couple there that I've just, I'm letting them go as call options because if it stays down here for more than a year, they're going to have some difficulties, let's say. But the financially stronger ones we doubled down on. And we added a couple more positions in quality, almost blue chip oil service companies. These are dividend paying companies that are profitable. I think they'll be profitable and generate positive cash flow even with lower usage rates for rigs and drilling activity in 2015. They're trading at around half of book value. So these are just great stocks. We did not go whole hog. We only bought a 1% position in each of them. We are staying small and moving slow because nobody really knows what the future holds. But if you've got a 5 to 7 year time frame and you're willing to scale into some of these stocks if they continue to drop, I agree with Mr. Schwartzman that this is a wonderful, wonderful opportunity for long-term investors. Be selective, stay small, but you've got to start looking at the energy names. Now, Howard Marks spoke at a conference recently, and he said he's starting to see opportunity in energy-related debt. Now, I haven't been real active in the high-yield and distressed markets since about 2004, 2005, when we were kind of working out of some of the stuff we bought in 2002 and 2003 as the whole world fell apart. Now, when I look at distressed bonds, my criteria is stolen directly from Marty Whitman. I'm looking for bonds that are, paying out a very high yield, that 15 to 20% mark, where if the company stops paying, now when I buy them, I want to make sure they're still paying the current coupon. I don't buy bonds that aren't paying a coupon. If they do go bankrupt, I want to make sure there's enough assets there that I get paid back the price that I get paid for the bond. Now, that's starting. The word is starting, folks, because haven't bought any, not quite ready to buy any, don't have any orders in anywhere, but we're getting there in some of the high yield energy names. We're going to see some defaults, we're going to see some prices collapse, but we're getting to the point where even if they miss the coupons and go into bankruptcy, we can still get paid back because there's sufficient asset coverage to return the amount that we paid for the bonds. There's a lot of energy related bonds right now trading between 50 and 75 cents on the dollar, still paying the coupons, and coupons now are very high, 12 to 15% based on the current price. So that's an area that's getting interesting. I will, in our little weekly visit, I'll tell you if I start buying them. But I'm getting interested. There's definitely some bargains and some values popping up in the high yield energy sector. And in fact, that's one of the things people are really worried about because energy is a big percentage of the overall high yield market, and a collapse there. We could see some margin related selling in some of the funds that specialize in high yield energy, and the hedge fund space could get kind of interesting for a while. So we'll see how all that plays out. Now, let's see, what else do we have here? Okay, moving along. I want to talk about a bank stock that got taken over this week. This is a stock that we bought back in 2011, so it wasn't in the Banking on Profits portfolio. I'm sorry, 2012. We bought this stock. By the time I started Banking on Profits in June of 2013, the stock was trading right around book value and did not meet our bargain criteria for purchase levels. But Heritage Financial, symbol HBOS, was taken out this week by Renaissance, RNST, a southeastern bank that has been growing via acquisition over the last year. Now, we paid $11 or so for this stock back in May 2012. I wrote about it that day on realmoney.com. The bank was trading at 80% of book value. They had non-performing assets of just 1.27%, and the equity to assets ratio was just about 9.7, as I recall at the time. So just a nice, safe, cheap little bank based out of Albany, Georgia. Not a particularly big bank, had about $1 billion in assets. The stock moved up as we went into 2013, as I mentioned. Trade at book value a little bit above, so we weren't able to add it to the Banking on Profits portfolio. And the stock just kind of drifted higher over time. Now, so did book value, by the way. When we bought the stock, book value was about $13.50. It's $18.25 today, and Renaissance is paying us a nice little premium. They're going to take our offer is valued at $27 a share. Stock's trading at 25, 23. Not bad from $11 in 2 years. Now, when we were examining the bank, we know there was a bunch of smart and activist bank stock investors in there. EJF Capital, not really activists, but they are really smart when it comes to small bank stocks. Clover Partners, our friends at FJ Capital, all had a position in the stock at the time. So we lined it up. We bought a little bit of it, about a 1.5% positions, usually what we've been doing with most of these little banks. And we've earned a giant rate of return on the thing, 2.5 times our money basically in just a little over 2 years. Now, here's the thing. When I put my buy list together and sent it out to members of Banking on Profit, the regular service this Friday, I had, I think it was 22 banks that traded below 85% of tangible book value, had nice, safe balance sheets with plenty of capital, loan portfolios that were in strong shape with very low non-performing loans and non-performing assets, and the vast majority of them have an activist or smart investor involved in the stock. We've got all our ducks in a row in most of these little banks. So 22 stocks, you can build a nice little portfolio out of that at this point in time. And I will tell you that is going to be, going into 2015, that's the major portion of my portfolio. I own the deep value stocks, but the vast majority, let's say, of what we're doing is in the community bank stocks because they are cheap and they are very safe and they're way off the radar screen of Wall Street and all of this macro nonsense that's going on in the world. Moves taken by Vladimir Putin in Eastern Europe, continued turmoil in Greece, real slow European economy, and now the tumbling price of oil really don't mean much to this portfolio of little banks. The credit conditions are getting better. Loan demand is rising ever so slightly. Net interest margins are still a problem, but that could actually improve if we do, in fact, see the Fed begin to raise interest rates next year. So it's a perfect storm in the world of community banks. We're going to see M&A activity pick up. There's a lot of regional banks out there that are looking to grow, and the only path to real asset and earnings growth today is by acquisition. So I think the BBT deal for Susquehanna shows that the larger regionals are now going to start getting involved in M&A transactions. That's going to pick up the pace quite a bit next year. So we've got all these banks trading very cheap. They've got great balance sheets, and I think the stock prices are going to go a lot higher in 2015. We're also seeing buybacks and dividend increases and just all sorts of positive activity in the sector. So much like Heritage Financial has provided us with this huge rate of return, I think we've got a lot more that are going to do the same. Now, I don't know how many takeovers you've participated in the last year. I have to tell you, in the bank stock portfolio, between stocks we bought like Heritage before we started the newsletter, stocks in the newsletter, and those in our 10 Tiny Banks report, so far this year, we've benefited from 10 bank takeovers in the portfolio and portfolios that I manage. So each one of those deals has had an annualized rate of return north of 40%. This stuff works. You really need to be involved in it. Even if you're a day-to-day swing trader, you should have some portion of your funds in this community bank space. I cannot emphasize it enough. As we head into 2015, and I know we're close because my wife is already running around the house getting things ready for the Christmas Eve open house that we have down here. So the end of the year's got to be pretty close. But anyway, I guess we're just going to live in a party atmosphere for the next couple of weeks till Christmas Eve actually gets here. Ran the screens this morning, and outside of the community bank space, guys, there's not a lot to do. Okay, so you need to take James Montier's advice when he quoted Winnie the Pooh, saying, never underestimate the value of doing nothing. When I run my perfect stock screen, I got 29 stocks. 14 of those stocks trade for less than $20 million of market cap. When I ran my Walter Schloss screen, I got 27 stocks returned, and 13 of those are less than $20 million in market cap. Neither list has a stock of over $1 billion in market cap. There's not a lot to do. The larger stocks, from my point of view, are pretty overpriced here. I think you ride with what you got, but you need to sit back, be still, and outside of community banks and a little bit of energy, not do much of anything here. It's worth noting when I run my absolute strictest screen that has just strict, severe margin of safety requirements with just bulletproof balance sheets, nice profits, adequate dividends, good dividend coverage, interest coverage. It's just, these are just absolute bulletproof companies. There's 8 stocks out of a 7,500 stock database. Usually that number, it's never large, but we get about 30 on it in normal times, and in a really bad market that's falling, we might get 70 to 75 names. We have 8 today. So the deep value pool is very limited. You really should be focusing a little bit on deep value. There is some stuff to do. There's a few nets around, but really the exciting activity for 2015, I think, is in the community bank stocks. That's where I would have most of my effort. Now, got the office door closed. The wife thinks I'm working really hard, but they're about to kick off this football game. So I'm going to go watch the Army-Navy game. I encourage you to do the same, and I'll talk to you guys next week.